For those of you who have been following our series, How Options Work, we started with the basics, just kind of an overview of how the options model works, how we need to think of it. We talked about in the money, out of the money. We discussed extrinsic, intrinsic value, what to look for, the bid, the ask, volume, all of that before we actually got to this video, which is today we're going to talk about actually placing an options order. So today we're specifically only going to talk about placing a call. So it's going to be a debit. So we're going to buy a call. Now, we mentioned in the past what we need to look for when we're actually placing a call is that we want to be as close to in the money as possible, if not either one strike in the money, or if we're just kind of at the money with that, the very first out of the money strike, we can do that as well. The reason that we would do that is because it's going to give us the highest delta and it's going to give us the best bang for our buck, right? So when we're talking about purchasing something, we're going to purchase a call here, but we want to have enough intrinsic value within our Tesla call here that we're going to buy. So if the stock kind of goes against us, we're still going to be a little bit in the money, or if it does actually go out of the money, we're still going to have a pretty strong chance for it to expire in the money again. And we also want to have a little bit of extrinsic value because if we do get that nice whip in our direction, we want to take advantage of that volatility expansion in our options premium, and that'll give us more money. So what we're going to do here is we're going to look at our deltas. So we have our delta here right around 50. We're going to take this strike right here. We're out in the March monthlies, and we're going to purchase this 262.5 call. Now, if we were going to buy this, what we're saying, our assumption is that we think Tesla is going to go up before March 21st. You have right around a $28 expected move in here, and we're thinking, hey, we're going to move up. We're sitting at the 262.67. We think we're going to go up around $28. We're going to expire right around that 290 area in here by this expiration. Is just kind of all things being equal. That's kind of how we're going to be looking at it in here. So if we were to purchase this, we have a 53 delta in here. We have a 53% chance that this option will expire in the money. Now, the thing that we have to realize with our calls that we're buying right here is that we have right now, we only have 0.17 cents of intrinsic value in here. So we can purchase this. It's all right, but we really only have 17 cents of that intrinsic value. Everything else in this call is going to be made up of extrinsic value, meaning it's going to be made up of theta and volatility, etc. If we were to go here, depending on our risk profile, if we can't afford to purchase this 260 call, this is going to be a little bit better for us because our delta pretty much stays the same. Our spreads are more or less the same as here, right? So you got about 20 cents here. So not getting hurt much in the differential here. And we're actually going to be about $2.60 in the money, which means we're going to have $2.50 already built in intrinsically to our call here. So if we do expire, if all things being equal, we don't move anything, the stock stays the same, we're still going to have right around $2 in here left of our premium. Whereas if the stock were to stay the same here, we would only have about 17 cents, right? So this is going to help us just a little bit because it's not going to expire to zero. If we were purchased the 265 and then Tesla just stays the same or expires at 262, then this 265 would be worthless. It'd be worth zero. If it stays the same at 262 and we purchase the 260, then we're going to expire at $2. So we would only lose 1,400, not the full 16. Whereas at the 265, we would lose everything we put in here, right? So that's kind of how you have to look at it. And we are going to have a little bit less volatility in here, but we're still basically only a couple strikes out. So it's not going to affect us that much. So this would be something that we would rather purchase, right? Because we already have that intrinsic value in here, just a little bit. It's not a lot, but we still have it in here and we still have enough volatility and enough delta. So our probabilities are still above 50%. We have that volatility in here. So that could get a nice move in here in the next couple weeks or so before this March 21st expiration date. So what do we want to happen? If we purchase Tesla, we want this stock, or we purchase this Tesla 260 strike, we want Tesla to go up. Now, all things being equal, if we move up $5 in here, then our delta is going to adjust our options premium 55 cents each dollar it goes up, right? So that's going to be $2.50 we're going to make just in a $5 move. That's not including the gamma. That's not taking in our theta. We have all of those other videos in our other Discord or on our YouTube channel. You can find out those if you want a better definition of what delta, gamma, theta, and all those mean. But for all things being equal right now, this delta is going to affect our call here, $2.50 if we get a $5 rip in here. Now, if we move up $5 more quickly, then we're also going to have that delta, but we're also going to have that volatility expansion on here. We're going to have our theta decreasing. So we're actually going to be making more money quickly. Whereas if it takes us 2 weeks to move up $5 and we close at 265, then really we could actually lose money in this call, and we would only be $5 in the money and only have $5 of intrinsic value. So we would only actually, we'd probably lose all this money and we would expire at $5 in here. So when we're talking about these bids and spreads in here, we have to also think in our head, we're multiplying all these by 100. So just because this says $16.10, it's actually multiplied by 100. So this would cost us $1,600, right? And if it expires in the money $5 in, it's only going to be worth $5, which means it's only worth $500, right? So we have to keep that in mind as we're looking at this. So we're going to purchase this 260 call right here. Our delta is 55. You can see our theta is 52. So we're actually going to lose $52 every single day if the stock stays the same, right? So all things being equal, every single day, we're going to lose $52 of our premium in here. But if the stock continues to climb up, this is going to offset with this delta here. So if we move up $1, our theta isn't really going to matter, right? Because there's a $3 differential here. Our theta is actually $3 lower than our delta currently here. So we're going to lose $52 if we get $1 up by tomorrow, but we're also going to gain $55 if we move $1 up by tomorrow, and so on and so forth. So we have to keep in mind when we're purchasing this call, what are we expecting, or what is our underlying assumption that we want to do, or we want Tesla to do? And that's going to be Tesla is going to increase in value, and we want to do it very rapidly, because if we only kind of stay where we are at, we're going to lose money on this call, but we're still going to have a little bit of intrinsic value, right? So if we're just trading the option, we want it to move up quickly, take our money and get out. We want that 25%, those the 20 to 40 to 50% range profits, take it and get out and leave it, right? But if we are playing Tesla and these options as if we're using them as a coupon, which is what they were originally built for, then it doesn't matter what Tesla does. We'll lose money on our premium, but we can exercise this option anytime we want. So we can purchase Tesla at a cheaper price than what it's currently trading at. So right now we can pay a premium of $1,600 to purchase 100 shares at 260, even though we're trading at 262. And if this keeps on rising and rising, and say it slowly rises, only that $5, right? And we expire or close to our expiration date, we're only $5 in the money, and it looks like we're only have $5 worth of intrinsic value, no extrinsic value whatsoever is going to be left in our option. Then we can pay that premium and exercise our right in here to purchase the shares, and we'll actually be buying the shares at the cheaper price, and we'll be paying a lower premium as well. So that is what these options are originally used for. We're going to use them as like a coupon, right? That was kind of like our first example that we used when we were talking about how options work. We got kind of explain them as a coupon. So you're paying a premium to get a coupon so you can purchase these for a lower price. But what we want as options traders, where we strictly trade options, we don't want to get stuck with any long stocks or anything like that. Just in our kind of like our trading portfolio, we have to look at our risk profile. We want to be right around the 55 delta. We want to be in the money. We want to have a decent amount of intrinsic value. We want to make sure that our price is good, that our spreads are looking pretty decent in here. And then we also want to purchase something that we think is going to rise up pretty quickly. We can take our money and get out. So we want Tesla to go up as quickly as possible, as much as it can. And then we want this options premium to increase in price from the $1,600. Maybe you get $1,800. We get a couple dollar move in here. And then we want to get out. We don't want to wait forever in this trade, and because we don't want this theta to eat away at our options premium. So every day that we have this on, we're losing money because all options premium have a shelf life. So that is what we're looking for here. And that is what happens when you purchase a call. So again, just to reiterate, what did we do? What were we looking at? We were looking at our bid sell here. We were looking at our delta. We also had our volume in here, which is Tesla. Everything's liquid. Don't have to worry about that. If something goes wrong, we can get out quickly, right? We're looking at our theta in here. It offsets our delta. So if we get a dollar move up, our delta will make up for this daily loss in our theta. If it moves down, then we're going to be losing this $55 here and the $55 or the $52 with our theta. We have enough intrinsic value in here that we're not going to expire worthless, but yet we're still close enough to at the money to where we have a lot of volatility in here, and volatility could only expand in our direction if the stock rips up quickly. All right, guys, I hope that made sense to you on purchasing your first ever call option. If you like this video, make sure to check us out on all of our social media. We also have a Discord service if you're interested, and you can find all of our socials in the description below. Feel free to like and comment with any questions or concerns you may have.